We've got another informative week coming up, even if the number of FTSE 100 firms with scheduled statements or events is down to just 3. From a macroeconomic perspective, central banks yet again will take centre stage. This is because we have monetary policy statements from the US Federal Reserve on Wednesday the 13th of December, and then on the 14th we've got the Bank of England and the European Central Bank. We can see the interest rate history for all three since 2007 right here, and the Fed is expected to raise interest rates by 1/4 of a point, the third hike this year and fifth of this upcycle, to 1.5%. It's also expected to press ahead with quantitative tightening, or QT, and keep shrinking its balance sheet, although the new Fed chair, Jerome Powell, who takes over in February, has already said he sees the Fed's assets shrinking to between $2.5 and $3 trillion, rather than taking it all the way back to the $800 billion where things began before the Great Financial Crisis. Now, as we all know, the past is no guarantee for the future, but Powell's comment may offer some reassurance to bulls of UX stocks given this chart, which shows the historic relationship between the S&P 500 index and the Fed's balance sheet. It then gives a projection of the central bank's assets given the QT plan the Fed has already outlined. On that basis, QT could end in late 2020. The ECB is expected to leave interest rates unchanged at 0 and has already announced plans to taper its quantitative easing, or QE, programme from 60 billion to 30 billion euros a month from January. The Bank of England is expected to leave rates unchanged at 0.5% after November's increase, the first in a decade. Markets currently expect 1/4 point increase in each of 2018 and 2019 to take the figure to 1% by the end of 2019. Company-wise, a handful of FTSE 100 firms will be joined by a good number of FTSE 250 ones in releasing results or trading updates. They include construction support services specialist Balfour Beatty on Tuesday the 12th, house builder Bellway, retailer Dixon's Carphone and oil services player Wood on the 13th, and then come Bunzl, Centrica, Ocado and Sports Direct on the 14th. But the update which could create the most fuss in the week ahead for me is the interim results statement due from equipment rental expert Ashtead on Tuesday the 12th of December. It hires out everything from forklifts to earth movers to scaffolding. American subsidiary Sunbelt generates more than 90% of the company's profits, and the shares, having already done well, have gone ballistic since the US presidential election of November 2016, powering towards new highs in the £20 range. This enthusiasm can be attributed to two things in particular. First, the so-called Trump trade. Roughly half of Ashtead's sales in the US are construction related, so the president's plans to kickstart the US economy with tax reform and big infrastructure spending projects could well be a potential positive. Second, oil. Oil is rising again back above the $60 a barrel level, and those US shale drillers in Texas or North Dakota will need kit to help them drill. This next chart shows how Ashtead's share price and oil seem to relate, even if the past again is no guarantee for the future and correlation isn't necessarily causation. Interestingly, Ashtead shares have largely ignored a wobble in the US dollar against the pound, even though this decreases the value of American profits once they're brought back into sterling. Keep an eye therefore on the dollar as it reacts to the Trump plan and the pound, which is largely being driven right now by those Brexit talks. Now, so far as the first half numbers themselves are concerned, September's Q1s on a reported basis showed increases of 16, 19 and 20% in sales, pre-tax profit and earnings per share respectively. Now that seems a pretty fair benchmark for the first half figures, especially as the analyst consensus calls for increases of 13, 19 and 16% in sales, pre-tax profit and earnings per share for the full year. Also keep an eye on the dividend. You might not think Ashtead's got much to offer here given its forecast yields around 1.5%, but the company has increased this cash payment to shareholders every year for the past decade, which is some record. At the first half stage last year, the dividend per share was 4.75 pence. Thank you for watching, and I look forward to seeing you next time.